The foundation of any consistent trading strategy is not your entry signal or your exit target, it is your position size. If you get this wrong, the best analysis in the world will eventually blow up your account. The core formula is simple: your position size is equal to the amount of cash you are willing to risk on this trade, divided by the distance of your stop loss from your entry. Let's break that down with a concrete example. Imagine you have a $10,000 account and you decide your maximum acceptable loss per trade is 1%, or $100. That $100 is your risk amount. You see a stock trading at $50, and you place your stop loss at $48. Your stop loss distance is $2 per share. Now, apply the formula. Take your risk amount of $100 and divide it by your stop distance of $2. The result is 50. This calculation tells you that your correct position size for this specific setup is to buy 50 shares of that stock. This is the only size that aligns your risk with your predetermined limit. Notice what this formula does not care about. It does not care how much total buying power you have. You might have enough cash to buy 200 shares, but if you do, a single stop loss hit would lose you $400, which is 4 times your intended risk. That is a catastrophic mistake. Why is this discipline so critical? Because trading is a game of probabilities and inevitable losses. Even a strategy that wins 60% of the time will have streaks of 2, 3, or even 5 consecutive losing trades. If each loss wipes out a week's worth of gains, those streaks will destroy your account instead of just denting it. By sizing correctly, you ensure that no single loss feels catastrophic. A 2% loss is a setback, but it is recoverable. A 10% loss requires a massive 11% gain just to break even. Proper position sizing keeps your psychology calm and your capital safe for the next opportunity. This method also scales naturally with your account. If your account grows to $20,000, your 1% risk becomes $200. You can then trade larger sizes as your skill proves itself. Conversely, if you take a loss, your next trade automatically assumes a slightly smaller risk, protecting your remaining capital. Ultimately, position sizing is the single most powerful tool for longevity in the markets. Master this formula, and you separate yourself from the gamblers. Ignore it, and you are one unlucky trade away from being out of the game. Trade the right size so one loss is just a small speed bump, not a roadblock.